Good afternoon. Thanks for joining us today. My name is Corey Webb, and I'm the Marketing Director here at ChurnZero, and I'd like to welcome you to our webinar titled Finance and Customer Success Come Together to Chart a Clear Path to Profitability. Before we get started, I'd like to remind you that we are recording today's session, and a link to the recording will be available 24 hours after this webinar. Throughout the presentation, we welcome you to submit your questions for Alli and Randy, and we will get to as many as we can during the end part of this webinar. Now, I'm pleased to introduce to you today our speakers. First, we have Randy Wootton, who is the CEO of Maxio, which is a financial operations platform designed to meet the unique financial challenges of B2B SaaS companies, including billing, subscription management, revenue and expense recognition, and SaaS analytics. Now we have Alli Tiscornia, who is our Chief Customer Officer here at ChurnZero, which is a customer success platform and partner for growing SaaS and subscription businesses. Now, today's webinar is about bringing together finance and customer success, and I think we have the two perfect speakers here to do that today. So with that, I will turn it over to you, Alli, to get things going with talking about cross-functional alignment.
All right. Well, thank you very much, Corey, for the introduction. And thank you very much, Randy, for joining me on this. I have been super excited about this particular webinar because I am asked over and over again by CS professionals, which of my relationships on the exec team is the most important to me, which is the one that I value the most. And I think sometimes they are surprised by my answer. My answer is always my relationship with the CFO. I think that's one of the most important relationships I have on the executive team. And the reason I think it is because I think CS needs to have more of that kind of relationship with the CFO because we have to be able to speak each other's language and we have to be able to understand. CS needs to be able to understand what the CFO is looking for from a metrics perspective, and CS needs to understand what is driving the business so that we can communicate in the same language. And that's one of the things that I think CS leaders are always very nervous about is, oh, am I just going to be having math conversations with the CFO, right? And it's not just about the math, it's about the business and what's driving the actual business. So let's talk a little bit about what some of those barriers are to alignment, right? Let's move to the next slide, Corey, if we can. So I think some of the things that are a barrier to having a healthy relationship to the CFO is when CS comes to the CFO with surprises related to budgets, right? CFOs hate surprises. So please, 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 if you take away anything from this webinar, please make sure that you are in constant contact with your CFO, especially as it pertains to, additional headcount and anything related to how the customer base is doing, right? A CFO is planning for the year, right? They have to report the metrics for the year to the board. And so they are looking at these metrics all the time. And you want to be able to highlight if there are any issues or if there are any problems as soon as possible. And you also want to make sure that you are tracking your headcount appropriately and you're also measuring against your CSMs, how much revenue they're actually tracking, right? One of the things that I think is kind of interesting that I hear from CS professionals all the time when they go into conversations with CFOs is they talk about, headcount as it relates to how many accounts a CSM is managing. And a better way to think about that in the language of a CFO is the dollars associated per CSM.
Yeah, I think that's right, Alli. I think so just a little bit of background and context, in addition to being the CEO of Maxio, I've been CEO of a couple other companies, but I ran at Salesforce the customer success products and have run success teams previously. And so have a sweet spot for this function and what it can do as a revenue driver for SaaS businesses. It's the core. And I think your point is spot on in terms of how do CS leaders think about framing their business in terms of business impact metrics versus just activity metrics. How many tickets have been processed or how many activities are done, health checks are done. And so it's sort of how do you build a data-driven understanding of your function as CS, and how does that translate into the business impact, primarily on renewals and churns, which we'll talk a little bit more about. But I do think CFOs, and Maxio sells to CFOs, so I spent a bunch of time talking to them about it. Like, what they care about is growth and churn and cash.
Exactly.
And so to your point, like being able to frame what you're doing to impact either revenue growth or churn, reduction of churn, or savings is really the dimensions in which the CFO looks at the business.
Right. And along those lines, I know one of the things, this is a particular pet peeve of mine, Randy, is I know CS teams are always looking at customer satisfaction and net promoter scores. And those, are very important metrics, right? We don't want to dismiss them. But at the end of the day, if we're going to be looking at compensation for CSMs and things like that, it really needs to be on the dollars that they're managing, not just simply customer satisfaction, right? Customer success teams are not happiness teams, right? They really are drivers to the business.
100%. And I do think there is a distinction you find in how people build their teams, in terms of sometimes they have customer success focus that are focused on retention, and they have renewal managers that are driving commercial conversations. But I mean, one of the old adages in customer success is, happy employees make happy customers, and happy customers spend more money. So I do think, as a CS leader, being focused on your employee engagement and making sure they have the tools, process, and systems to be to do great and grow in their careers, and they are focused on making happy customers. But then it's that evolution into how do you have commercial conversations with those customers, and it's the business impact, not the functional impact, that is going to really pay off for CS leaders as they define their place on the executive team going forward.
Absolutely. And I love that part about happy employees make for happy customers. It's very true. All right. I think we are on to the next slide, where we talk about our financial metrics. Randy, I'm going to hand this one over to you because you are the expert on these metrics, and I'll jump in with some thoughts and opinions from a CS perspective.
Yeah, that'd be great. And certainly not an expert, but it's been a long journey. I've been in, we called it web-based ASPs back when I started in what is now SaaS cloud business models. And the core, just we're going to run through some basic definitions for folks to help frame those business metrics we were talking a little bit about. So everything starts with ARR. So ARR is the annual recurring revenue for many companies that are using monthly billing. It's just your MRR that shows up in your financial statements times 12. It also can be tied to your annual contract. So you have a better sense when people are closing deals, when your salespeople are closing deals, are they closing an annual contract, or are they closing a monthly contract? And so the first thing with your CFO to talk about is, hey, what is our MRR? Literally, what was the recurring revenue that we had in that month? And that will get you your ARR writ large. And there are things that drive it. One is new bookings, and that bookings can come from new sales. It can also come from expansion. So as a CS team, if you're responsible for expansion, that's a great way to show your impact on ARR and revenue. The offset, obviously, is contraction and loss. So contraction is when customers spend less or reduce the number of seats, et cetera, or they churn. And so we'll talk a little bit about that in a second. But ARR is the metric we use. It's a non-GAAP metric to say, hey, how's the business growing broadly across our customer base? Can you go next slide?
Yeah, and just to the point earlier that I made, that is the metric. ARR is the metric that you want to measure against for your capacity planning and your headcount, right? Is how much ARR does a CSM actually manage? That 100%. Is something that a CFO is going to relate to.
Yep, and it's absolutely, it's like a book of business.
Yep.
Right, and so then one of the things people can think about is having, as you start to get bigger, is start doing customer segmentation, and we'll talk a little bit about this as well. And customer profitability. Customer segmentation can be tied to how much ARR they have. So if you have a set of customers that are greater than 50,000, well, that's going to generate a certain amount of revenue. And so you can invest in that with more seasoned customer success people. You can do additional programs and such to help grow their business and ensure they renew. Whereas for those much smaller customers, it's hard to assign CSMs to them because they're not, that customer is not going to be profitable. So that's where then you're working on those scaled models through communities and webinars and automated chat interface for support. And so getting to unit cost economics in addition to understanding what the ARR is critically important as you structure your customer success organization. So one of the things, I mean, the starting point is actually, for me, as you think about the metric for CS, where they have all the control, not all the control, but sort of the closest kind of alignment between their daily activities and how it manifests in continued ARR growth, is renewal rate. And the distinction between renewal rate and what we're going to talk about in gross retention in a second is renewal rate. Think of it as the contracts that are available for renewing. So you have a set of customers, either if it's monthly, those set of customers are coming up every month for renewal, or if they're on annual contracts based on when they sign the contract. So some signed in December, some signed in January. Every year, they're assuming it's an annual contract, not multi-year, that set of customers are going to come up for renewal. And as a CS team, that is probably the most important thing that you want to be focusing on, is what percent of the available logos and revenue, or ARR, is renewed. And industry best practice is like 97%, 95 to 97%. That means 95% of the logos that are up for renew, you renew. Now, this is a subset of the overall gross retention, but because you only have a certain amount of customers that are up for renewal every month, unless you're a complete MRR monthly contract business. But most customers, most SaaS businesses are trying to get into the annual contract. And so really understanding your renewal rate is the starting point, because then you can also create engagement plans with executives, outreach. You can start using Pendo to triangulate on, or other tools like Pendo to triangulate on usage to help forecast is something going to renew or not. I don't know, Alli, this may be a good place just to ask, like, for you, how do you think about best practices for driving renewals and renewal rates?
Yeah, exactly. I mean, I think one of the things that is important to me in the way that I look at this is, because we are on annual contracts, and I've always dealt with kind of annual contracts, I look at measuring the team on kind of like a quarterly basis, right? So my core cohort is always usually what's happening, what's up for renewal in the quarter, how are we measuring against that up for renewal rate in the quarter, and what are we forecasting against as it relates to this retention number, right? And so for me, it's always about not just logos, but also what the dollars are that we're retaining, right? And we're going to talk about that as GRR, because I think that's a really, really important metric for folks in CS to think about. And I know there's been a lot of language in the past year or so, or 2 years, about the importance of NRR, and we'll get to that in a minute. But I really like to focus equally on GRR and NRR, because GRR to me tells you really, truly the health of the business, right?
Yeah, well, I think
rate and your GRR are the health of the business.
Yeah, the three are connected. So you start with the renewal rate, because that's a subset of your total gross retention that's available for being retained over a period of time. So think of like renewal rates being tied to contract end dates, whereas gross retention is based on start dates. So you look at gross retention over a period of time. It could either be a quarter, it could be the last 12 months, or it'd be year over year. But really, gross retention is, hey, you came in with a set of customers and they had a certain amount of spend. What happened? And the thing about gross retention is it can never be greater than 100%. Right. Because it's your starting point, and then you subtract out your churn and contraction. So churn is people who've lost, been lost. Contraction is they reduce their spend, fewer seats, fewer divisions, whatever. They right size the contract. And so when you think about trying to solve for a gross retention, healthy benchmarks are like 80 to 85%. I would say most of the top end SaaS companies that I work with that are more annual contracts, it's like 90%. 90% is your gross retention target. So again, renewals is a subset of customers. We have across our customer base 1,000 customers that are monthly, 1,000 customers that are annual. So we have a little bit more complexity in terms of how we think about our renewal rates versus gross retention. When you have all 100% annual contracts, they're a little bit more aligned. But again, it's who's up for renewal versus what's the gross retention. So gross retention.
Sorry, Randy. I was just going to say, I think the interesting thing about GRR too is the contraction issue, right? Because that's
Yeah.
when you start to see discounts, right?
Yes.
If you're having to discount, right? If you're having to discount for the renewal, then something's going on, right? And you really want to be focused on what that contraction looks like and what those discount rates are looking like with your GRR.
Absolutely. Other point that you made earlier, which I think is important, is you want to look at both of these metrics, all these metrics in terms of logo count and ARR or revenue, because there are slightly different nuances in terms of, let's say in gross retention, you're keeping your largest customers, you're spending the most money, but you're having a bunch of small customers churn. You can look at that and say, well, what's going on? Is our pricing out of whack? Do we not have the right products? But it can get masked if you just look at the high level revenue / ARR versus the logo count. And so I think it's
absolutely. I've been in plenty of situations where the logo number looked really good, but when you unpacked that in the GRR, you're like, oh, wait a minute, we're not actually saving the dollars that we need to be saving.
That really matter. Yeah. So that's the flip side. All right. And so then we go to the next slide, which you, Alli, were pointing to, which I think a lot of CS guys are like, yay, we drove NRR. So NRR is really what's been happening broadly across the business in terms of you had a set of customers come in, some churn, some contracted, which you already talked about. What you hope is you have more that expanded. So they expanded by buying more seats, they expanded by getting additional divisions, or they expanded through cross-sells or add-ons. So at Maxio, for example, we brought 2 companies together. A lot of our expansion is driven by selling Chargify to legacy SaaS Optic customer and SaaS Optics to legacy Chargify customer. That's a big driver of expansion, and us getting that right, that cross-sell motion is really important. And so I think for ideally you want it to be greater than 100. Best practices, you see like 110, 120% NRR. And when you look at stock performance of companies that are outperforming the stock market, they have NRR in that 120 plus range. Yep. And so your CS team, if you structure it that they're commercially oriented, this is a set of skills in terms of being able to come in and increase price as a driver of expansion, increase seats, increase capabilities, getting introductions across large organizations to additional divisions. It's a different type of orientation than, hey, I'm just going to make you happy. It's we got to look for where there's money. You know, I call it.
And how do we grow the business and how do we expand to different departments within the business? Yes.
And Alli, that's a great point. Like we're talking to CFOs, the difference between if you want to be the master of your own future, it's coming into a CFO with a bottoms up forecast across your customer base and saying, these are customers we think are going to expand because we're only across the business, 20%. And we think there's going to be expansion opportunities. These customers we think are at risk. These customers are going to stay flat. And your ability to help inform that conversations keeps you from inheriting a target, which you then have to go figure out how to deliver on.
Exactly. And what I think is also kind of interesting about this NRR number too, is if you are solely reliant on just license upsells, right? And you get into a situation where your customers may not be expanding or you're not able to expand into different departments, your CFO can also help you go back to the product team to argue for why we have to do additional products, right? If we're going to be able to drive this NRR number.
You got it.
Your CFO is your ally in that discussion.
And I think that's what we see in a recession is that it is easier to sell into your customer base than it is to go get net new logos. And so CS teams leading this and helping to, again, bottoms up where, or you don't have to, if you have a huge customer base, focus on the big ones, 80-20, but being able to go to your CFO, and if you're responsible for expansion and upgrades and renewals, and being able to say, look, I think this is the upside opportunity. And to your point, Alli, if there are capabilities that could be delivered, because you're also providing a lot of feedback into the product team in terms of what's not working or where there are adjacent categories, like you become the driver of the business over the next couple of years.
Absolutely. And that's how this all important question of the seat at the table, right? If you're able to have these conversations related to how you're driving the business, that's the seat at the table.
Perfect. All right. So churn rate, no one likes churn. Churn is basically the, again, you can do it by logos or ARR, is what have you lost? And It can either be churn or retention. I talk to my team about retention rate. And
I do too. I like that. Much better.
Churn rate.
It's our retention, yes.
But this is just basically, you know, how many people are you losing? And I think that the key on it is, look, we're going to have losses. You're going to lose to competitors. People are going to go out of business. But really getting clear on your loss reason codes is another thing that the customer success team can really help, is inform. Was it pricing? Was it competitive? Was it going out of business? What are you seeing across your customer base to inform product strategy, packaging strategy, pricing strategy? All of that is, so don't be scared of churn. It's just make sure that you have created a system that allows your team to input accurate information. I'll give you one example. So we have you think about churn happening throughout a customer life cycle, often at renewal, but it can also happen with products where they're highly configurable during onboarding. So if you're taking onboarding and you're going to 5 or 6 months for onboarding, you know, there may be a change of sponsor, there may be a change of prioritization. Like, there's all reasons why we call it failure to launch, that people weren't able to get live and then weren't able to get full adoption. And I think sometimes CS teams, you know, because you're all focused on renewal, you miss that opportunity to really talk about, you spend all this money to get these customers on board. You spend all this money to, you know, to sell them and get them on board. And if they don't actually launch, you don't get any of that payback on that customer acquisition cost. And so having that focus on that failure to launch and deciphering it, understanding it, and putting a SWAT team in place is as critical as understanding your renewals at the end, which lead into, you know, that loss category.
Absolutely. Renewals start on day one of implementation or onboarding. That's when it starts. You've got to be able to show time to value as quickly as possible. The other thing I want to add here is that when you're looking at your churn reasons, and again, to your point, Randy, customers are going to churn. It's a thing that we understand will happen. Obviously, you want to keep your rate very low. You have to understand why they're churning. One of the things that I always tell CS leaders is never give your CSMs the option of other. If you have your churn rates, you need to actually describe what is happening. It can't just be an other. And if you're going to have some sort of category that's other, it has to be a text field that they fill out, because there's no option for other, right?
Right. And just, sorry, going to the renewal side, I think one of the things we've refined in our own motion is we used to have lost to a competitor as a actual field. And what we've changed that to is, hey, we know they're probably going to a competitor, but what we want to focus on is, why did they go to that competitor?
Why did they? Yes,
pricing,
absolutely.
was it capability? Was it, you know, X, Y, and Z? We never showed them the love. And then they end up with a competitor is a separate question, because we want to understand where they go.
Right.
But it's the same thing like
it's not the reason. Category. It's not necessarily the reason. There's an underlying condition that is happening. Exactly. That's right. And that's what you have to get to.
Who knew you could have so much fun with metrics?
I know, right?
So the lifetime value, this is the way to think about this is what we were talking about a little bit earlier, is the magic of the SaaS model is that you get paid over time continually, right? And so the lifetime value, and it's a calculation of 1 over churn rate, but I think of it in terms of like, how many years is that customer going to be with you? So that you get the payback and all that investment in sales and marketing and the ongoing customer success investment. And so it's really important to understand lifetime value. There's a bunch of, it depends on why I don't have a benchmark there, because it really depends on the size of your contract, depends on the size of your customer acquisition costs. It depends on a bunch of factors, but understanding what lifetime value, how it's calculated, and the driver is the churn rate. So to understand lifetime value, you got to understand the churn rate. You all can help control the churn rate. The better it is, the longer the lifetime value is. So we can go to the next one. And so then you get this CAC, which we were talking a little bit about in terms of the customer acquisition cost, sales, marketing, and even the support function. If you have people helping on the implementation, are included in the customer acquisition cost. So it's the total spend. And the trick here, I think, is aligning your CAC with your cycle. So I've been at companies where as an enterprise motion, it was 12 months to sell. And so you would take some portion, call it 25% from the 4 quarters of your sales and marketing spend applied to the ARR that you had in that month, because it was a 12-month sales cycle. If you're in a 90-day sales cycle, or if you're in a 30-day sales cycle, you would just take all the customer acquisition costs in that 30 days and apply it to the bookings that you got that month. And if it's 90 days, you try to do it over the quarter. So I think the key to customer acquisition costs is matching the spend with the sales cycle.
Exactly. And CS leaders, don't be intimidated by this number. You're not necessarily going to know it. Your CFO is going to know it. And it's a good conversation. It's a great introductory conversation to have as you try to educate yourself on the business, right?
Yeah, Alli, just before we jump to the next one, I do think the most sophisticated companies are disaggregating CAC into new bookings and expansion. And this goes back to the point we were making before, that the most value is you're going to get out of current customers. Well, there's some marketing that's going to be spent on customers, like customer webinars, customer events. And so if you're seeing expansion growth, you want to understand is what's the investment. If you feel like as a customer success leader, you need more webinars, you need more workshops, you need more events. One of the ways to frame that is, let me show you what my expansion CAC is versus new bookings CAC. And so then you're having a conversation about that, and you're going to find that you're going to have and there are metrics out there and they're different for each.
It's a really, really good point.
So then you finally you bring those three pieces together, right? We started with churn impacts your LTV, then you have your CAC. So then you have this metric, which is broadly in the industry, this is called LTV to CAC. Everyone talks about it. Basically, what is the lifetime value versus what did you spend? Getting aligned on how to calculate it with your investors is critical, because they may be not allocating the full cost in the month or whatever. So you get metrics definition. What I would say in general is you hear a 3-to-1 ratio, meaning that you have them for 3 years compared to the acquisition cost that it took to get them. So if they're and that goes into a CAC payback period, but if they're churning in year 1, you're upside down from a business perspective.
And this is to me, this is one of the most important numbers I think that a SaaS or that a CS team should know. And I don't think we, especially as newer leaders, pay enough attention to this particular ratio, but it is hugely important to know what that payback cost is, because if you are seeing customers churning in the first year, right, then you're definitely upside down. And this is going to be a number that your board is going to be particularly interested in.
Yeah, this and like magic number, there's 5 or 6 that, not pushing Maxio. We got a bunch on our website you can go check out, but there is a set of SaaS operating metrics, which are the standard, I call them efficiency metrics. LTV to CAC, magic number, a couple others are the ones that really matter outside the operating metrics of gross retention, net retention, et cetera. All right, next slide. All right, so what we've provided here this is from OpenView 2022 SaaS Benchmark Survey. OpenView Insight partners are great sources of information for benchmarks. There's some other partners out there. What I would suggest is work with your CFO to find out what you want to use as the benchmarks. And so in this case, for example, you find, and a lot of them break them out by, I think Insight Partners actually just came out with an updated version, but you find out where you are in terms of your business size. And then if you focus on the SaaS value drivers, that third bucket, you see the things that we were just talking about: gross dollar retention, net dollar retention. In the parentheses is the 25th percentile and the 90th and the 75th percentile, with the median being in the middle. So if, for example, you were to look at a company that was 10 to 20 million bucks, you go down to gross dollar retention. As we mentioned, the benchmark is around 90. I think we said 80 to 85% is healthy. So that's at the 25th percentile in the market. The best companies in the world in gross retention are at 98%. Max you can do is 100%. So that's pretty darn good. And where you want to be is in that 90% range. So similarly with the net dollar retention, we talked about in that 10 to $20 million bucket of being north of 100%, and the industry leaders are 125%. So we hope this helps you sort of plot where you need to be. And then you spend time with the CFO talking about, this is where we are today. This is where we're going. It's a journey over a couple of years. These are the investments we're going to make in people, system, process, to outsourcing to make it better. And that's how you engage the CFO in that strategic conversation.
Exactly. That's how you will get the CFO on the hook for additional things that you need, as you said, Randy, tools, headcount, things like that, is to say, this is where we're at today. This is where we expect to be in terms of our benchmark, right? These are the things we need to get there. Absolutely.
And
All right. I love this particular slide.
Yeah, this is that great one that just captures that point we were talking a little bit about. Is it's easier to sell into a current customer base. Why? They already have an MSA. They already know you. Hopefully, if your biggest customers, they trust you. And so they will buy. They don't feel like they're being sold, especially if you present it in terms of value. Like, here's the value value realization. Here's the value validation that we've been able to do for you. Here's where we understand where your business is going. So having those health checks and deeply understanding what they're trying to achieve, and you get first shot as a customer success leader to tell them how you can help them grow. And if you can help them grow and help them grow their business or reduce their churn, then you're going to be able to sell more. And so the other
And
piece,
I want to add here that CS leaders, like, this is where, this is your value prop. This is where you cannot shy away from those commercial terms conversations, right? CS teams need to own the revenue and need to own revenue numbers, because you already have that relationship with a customer, and it's already easier to sell into the customer than it is to try to go out and get prospects, right? So if you already have that relationship, if you're already demonstrating your value to your customer, it's still okay to go ask for that deal and ask for that expansion.
yep. And then ultimately the business on the right is what the CFOs, this is addressing churn. If you're able to keep customers and they're spending at their level, that drops down to the profit because of the way the margins work.
Exactly.
So it's like they talk about the leaky bucket. If you got a leaky bucket, go fix the leaky bucket first, and then go figure out how to bring in more customers. But if you got a leaky bucket, you're spending all this money dropping customers in and they fall out of the bottom, then you're just in the evil cycle of, death spiral. So
exactly. You got to, and then that's when you really have to identify what's going on with those retention rates.
Perfect. Next.
All right. So along those lines, one of the things that you can do to really have those conversations around your retention rate is to use some sort of leading and lagging indicators around health scores, right? Health scores are really important, and it's not just about CSM sentiment, right? It's not just about how the CSM feels about the relationship. It's really about what are we seeing in terms of data that is leading to our customers renewing, right? And so when folks come to me and they talk about, health scores or churn rates or churn scores, one of the things I always like to ask them first is, what actually makes a healthy customer? Before you dig into why your customer is churning, what makes a healthy customer first? And then I think you play that against what you're seeing in terms of churn. I think it'll help you to identify what's happening in those accounts a little bit earlier on. And then I think it's also critically important that we've said this multiple times, that we're sharing, right? We're using the same language, that we are reporting on the same metrics, and that we are actually compensating CS teams on KPIs that actually matter. Okay, this is the one where I think we want to talk, Randy, a little bit about segmentation, right? And why segmentation is so critically important, right? So every customer is valuable, right? But not every customer has the same value to us as a company, right? And so this is where you really have to start understanding where you're going to put your dollars, where you're going to put your investment, where you're going to put your high touch CSMs versus what you're going to do with a much more digital based strategy, right? And where you're going to have renewal specialists versus potentially CSMs.
Yeah, I think so. A couple of things. One, every company kind of goes through this journey where they initially start with one product and one ICP. And, we're a mid-market B2B billing solution, and you got one solution. And then we brought two companies together. Now you have multiple solutions, and we're focused on companies that are early stage seed, Series A, all the way up to $100 million. And so I think there's a natural evolution as you introduce multiple SKUs, multiple segments, go multiple regions, that you have to then start thinking about that segmentation. but you'll hear terms like unit cost economics. Unit cost economics basically is how much profit are you making on each customer? Well, that depends on how much service you're investing. Well, how much do you want to invest? So talking to the CFO about how much profit, marginal profit do you need from each customer will help you start to inform what are the segments that you would want to define. You shouldn't have 20, right? It's probably 3 or 4. And classic, you have enterprise, mid-market, sort of
SMB.
Yeah, an SMB, and then free if you're using a PLG motion or something like that. People that are, trials. And so for each of those, though, understanding what's happening there is critically important. There was a question in the chat from Sumitra about hey, if you have a mix of annual, quarterly, and monthly contracts, how would you measure it? And I think this is a good place to start, is I think about customer segmentation by product, by region, by segment. And so if you have products that lend themselves to monthly contracts, so our billing solution is more monthly based versus our SaaS reporting revenue recognition is annual, we actually look at those separately because it does have different metrics. And if you have monthly contracts, you're up for renewal is just radical. So 1,000 customers are up every single month versus just 100 of the annual contracts. And so you can get having those two together conflates what's happening. So I do think it's important, primarily on the annual versus monthly, to set those up differently. It's often driven by product versus billing. So if you're able to tie it to products, then that will help you understand what's happening with those products. Is it easy to sell? Is it easy to renew? If there's churn, what's going on? And so I think that's part of this segmentation exercise. But if you've used customer success across product, region, segment, and do those pivots, you'll need to do that as you continue to grow and add products and segments and regions.
Yeah, I can't emphasize enough how important segmentation is. And I think that was a really good question, right? You would not want to have CSM managing all of those different contracts together, right? Because it becomes a distraction, and then it becomes very hard to be able to articulate your churn rates for those different things, right? A monthly motion is very, very different than an annual contract. Great point. Okay, so now we're on to, because I know we want to get to some additional questions. So now we're on to having this data first mindset. This is the most important thing that I like to convey to CS leaders is when you're having conversations with CFOs, just like you're having conversations with product, you have to have a data-driven mindset. You have to show them numbers. Anecdotes don't tend to work very well with CFOs, nor do they work very well with product leaders either. It's all about being able to show the data and then tell stories around that data. And
yeah, I think just building on
go ahead, Randy, please.
When I was at Salesforce, I spent 3.5 years there, and they had an enormous footprint, and they spent a bunch of time building out what they called an attrition predictor. An attrition predictor had this input. You had data from usage of the product, right? So Pendo or whatever. You had data in terms of monthly average users, the daily average users, what's been happening with the account. And then they could identify a customer in one of 4 buckets, and they focused their energy and effort on those that were red. I remember Mark Benioff, he sat in on our red account meeting every single week, and so then you use this health score through the initial contract, through implementation, onboarding, and anticipating renewal to better understand where accounts are yellow and red. But that's like a weekly motion, and you got to have enough data to inform who you're going to talk about. You're not going to talk about the whole customer base. You're going to talk about those that are at risk, and then you get your product team, you get your executive team to engage to help either. When some customers are not responding to your health check email, if a CEO to CEO outreach or a COO to COO outreach can make the difference, and then you're getting in front of it before it surprises. You also use those renewal meetings to help inform your forecast for the CFO. So the CFO is trying to figure out what the heck the forecast can be at the end of the month or in the quarter. If they're in that weekly meeting with you, they get a better sense for what's happening with customers and how that's going to play out on the business. So I think it all starts with that. What are you using as your radar, your attrition predictor, and do you have a company that is laser focused on that activity every week?
And I cannot emphasize enough the motion of meeting weekly to talk about what your forecast looks like, right? That is something that we do at ChurnZero. We talk on a weekly basis. Our CSM managers come with their numbers. We talk not only about our accounts, our red accounts, but we also talk about our expansion opportunities, right? And then that is what informs the forecast for our CFO.
Yeah. So I think we chatted about all these.
I think we did too.
Yeah, cool.
I
Yeah.
think we did too. I think it's time to take some questions.
Awesome. Yeah, thank you so much, Alli and Randy, for taking us through all of those metrics. Always a good refresher if you already know it, but then great if you're also learning on this webinar. So glad we got to go through that. I do want to invite the audience to please go ahead and submit your questions. We do have some that have come in, and we'll get to as many as we can. So we have a question that says, regarding churn, if clients on annual contracts churn less than monthly contracts, why not offer multi-year contracts? Are they just harder to sell?
That's an interesting question. I am a big believer in multi-year contracts depending on the complexity of the product that you're offering, right? It really kind of goes back to that time to value. If you can show time to value because you have a relatively, easy, if you will, product to implement, and it can show value within 30 days, right? You might not necessarily need a multi-year contract, but if you have a product that requires some complexity and some phasing to it, a multi-year contract actually makes a lot of sense because it's going to take a little bit longer for your customer to see some of that value longer term. They will be able to see some of it initially, but the longer term value might take a little bit longer than what you can see in 6 months or so.
Yeah, two other thoughts is if you're selling to the SMBs, everyone's freaked about cash. And so they will probably want to stay on a monthly contract for as long as they can, as they're trying to manage their spend and, shifting uncertainty about their own bookings and churn, et cetera. And so I do think it can be harder to convince them to go to annual contracts. People will use annual contracts sometimes and multi-year contracts to lock in price. So most annual contracts come in with a 5 to 8% price increase just as part of the renewal, reflective of, hey, we've invested all this energy and effort in building new capabilities and inflation, et cetera. So on an annual basis, your prices can go up 6 to 8%. Always turns into negotiation. And what people will do is say, hey, what I'll do is I'll give you, I'll hold the price. So let's call it 5%. For you to give me 3 years on the annual contract. So for me as a vendor, that helps because now I have more predictability on that overall revenue over time. Challenge is the buyer has to be confident in their own business to be able to do that. So for something like a Salesforce, a must-have system, or if you use HubSpot, like you might be willing to do that. You might be able to say, hey, I'm willing to commit at this tier for the next 3 years because I'm going to grow. And I know I'm not going to have any fewer salespeople, but I want to lock in that price rather than getting hit with a 6% each year. So there's some trade-offs there. But the other piece I would say is some of it is defined by the industry you're in. So billing solutions, we have annual contracts, but they get billed monthly. So rather than annual contracts paid up front, again, for the buyer, they might be better for them to be billed on monthly because of cash flow. And so being sensitive to what is the norm in your industry, but trying to stabilize the revenue over time is true. Everybody, the golden goose is annual multi-year contracts, is that just guarantees you that NRR over time.
And again, to your point, Randy, this is why segmentation really matters, right? Yeah. Understanding the customer base. If you're, selling to the SMB or smaller, it's going to be a lot harder to secure those multi-year contracts.
Awesome. Love that advice. We have a question that came in for you, Randy. It says, you mentioned that there's a collection of top efficiency metrics that every board and SaaS company cares about. What are they? Also, considering there's unlimited metrics to monitor, why those specific metrics?
Wow. So I have for my board 4 buckets of metrics that I use. I'm happy to, in the follow-up, provide that outline. I can't share the slide because it's got all my metrics on it. Yeah. But it's an aggregate. You know who does it really well? I would encourage you all to go to Ben Murray. I actually stole it from Ben Murray, the SaaS CFO or whatever his thing is. He's got a great course on operating metrics and SaaS metrics, and I stole his framework and have used it at this company, but it was consistent with kind of how I did it at others. What I would say is on the most important thing, not the most, but one of the important things with each of those metrics is to understand what your actual is each month against what your budget is. And then I actually have a component which is industry best practice. So if our gross retention is, we're targeting to be 90% this year and 88%, and the benchmark we're going is 95%, those would be the three numbers that we would have under gross retention. Net retention, we mentioned anything north of 100%, but again, it's kind of unique to or specific to how big your company is, what your ACV is, et cetera, et cetera. There are metrics like operating leverage and some other ones. So they're not 100, but there are probably 15 that for you as a CS leader and for you as a company, I would really encourage getting aligned, and I'll find it and send it in follow-up.
Awesome. Let's see, we have a question that is, if you were a younger, high growth company with 3 major enterprise customers, what would you prioritize in the customer success CFO relationship to prepare for an incoming of high volume of enterprise deals to come?
Alli, that's you.
I think if you're prioritizing, if I understand the question correctly, what do you need to be looking at in terms of those additional enterprise customers that are coming in? Yeah, I think you're going to want to know, again, what is the ACV of the deal? How many of those accounts can a CSM manage? Again, the ARR to CSM. What's the expectation there? And then what does the retention rate already look like of those 3 customers, right? Are you able to retain, have you been able to retain those customers? Because that's what you're going to want to lay out for the future.
Yeah, the only thing I'd add to that is, boy, it is hard if you're relying on enterprise, because enterprise sales cycle is usually longer than 12 months. That means you're usually dealing with big customers that, even though they say they want to do it the same way, they don't. And so you're going to have a highly configurable product. So I think the type of investment and that requires then you to have very knowledgeable people working on it. And so I think that requires an investment in like solution engineers or technical support folks, professional services, so that you're setting those customers up for success. The salespeople isn't selling something that's going to fail. And so you go through proof of concepts, you do those sort of things so that you know that when now you put it in onboarding, which is going to take a while, that at least you started it off successfully. And so it's an investment in, like I tell people, like we're a mid-market company and we're not going in enterprise, because enterprise sales motion is super expensive. It requires a bunch of people, and there are other people who do that. And so similarly, enterprise customer success is different than mid-market success. And I think talking to colleagues and friends for what you have to have across that investment for all those different roles, and is the company really willing to do that based on what they think they're going to be able to achieve in terms of the ARR per customer? The answer may be yes, but super hard to be a startup that's just focusing on enterprise.
Yep, I would agree with that, because there is a heavy investment in that. And I think one of the things that you'll learn very quickly is that a CSM is not able to do all of those different things, because to Randy's point, the implementation of an enterprise customer requires more than one person. It requires a process. It requires a methodology. There's an expectation with enterprise customers that you have an implementation methodology that's very well baked.
Yeah.
Hey, Corey, I'd like to address Guy's question, if you don't mind.
Please.
I haven't talked a little bit about it. It was, what about variable income? Sometimes it's a committed contract and we consider it ARR. Is that the right approach? Also, this revenue is volatile, meaning when it comes to renewal, there's a lot of contraction and expansion. Contraction hits the GRR badly. What is your observation on such? So there is a trend broadly in the market around people moving to usage and consumption type metrics. So you have a widget that you have that your customers are using, and you want the customers want to pay on that versus just a seats-based model. So that's usage or consumption. We do see we use that, and we see a bunch of customers that have that reflected in their overall pricing model. And to your point, it is nightmarish in terms of trying to understand the usage, the contraction, you know, they expand into overage one month and they contract the next month. And what does that look like? I would say industry standard is you kind of have a platform fee that you're trying to get either on a monthly or annual basis, and then you have an overage fee. And the overage fee is when they exceed the tier. So think about your cell phone, right? It used to be before unlimited plans, you would have, I don't know, 1,000 minutes a month. And then if you paid $30, and then if you went above 1,000 minutes, the next 100 minutes were at a penny a minute or something. But you can think about that on many different models. So we have customers like Motorola and Stanley Black & Decker that are involved in the Internet of Things, and they're trying to set up structures where they're charging usage of tools or usage of radios. So rather than people buying the radio, they're renting it, and then what's the usage? What the industry standard right now is to use an average of the usage or consumption trailing 3 months, so that you net out some of the variability. It is counted as ARR, but you use that trailing 3-month factor to help just dampen the volatility. In our world, what we look at is platform versus usage. So expansion for us is broken out into those two components. Contraction is broken out into platform and usage as well. The platform, we've talked a little bit about like what's happening there. You're driving more seats or you're losing more seats or whatever. And that usage base is something where you really want to look closely at which customers are doing it, when do they go into overage? Is that an opportunity to go sell them a higher tier? So it's a really interesting space. It's a lot of innovation in terms of pricing, packaging, what we call a monetization strategy, but you need a system to help support it. You know, that's what Maxio does. That's my advertisement for the day. But I do think broadly in the industry, you're seeing motion to that, because a movement to that, because usage better aligns the value the customer is getting out of from the product that you're selling.
Very interesting. That some complex stuff when you get into that variable component.
Oh yeah, it really is.
We have another question. Any points of view on how you might need to change or consider a change in approach to renewals and fast pricing in an economic downturn, if at all?
Yeah, I mean, this is where going and looking at industry reports. There's a couple out there. Sal's Capital's out there. We have one we produced, Maxio Institute, trying to figure out. There was one that RevOps Squared. Check out RevOps Squared. Their report's just about to come out. They have an N of like 2,000 of companies that have inputted what their growth rates were. So triangulating, what you're seeing is this compression of growth rates and increase in number of companies that are being acquired or going out of business. So I would just assume that your renewal rate is going to be less than what it was 2 years ago. If you're working with primarily VC-backed or PE-backed companies, which is what we do, and self-funded bootstrap companies might be able to make it because they don't have it, they haven't taken on as much capital, and they're not in that usually that high burn rate. So if you're selling a B2B SaaS tech companies, you can expect, I think, in the recession to have lower renewal rates, lower gross retention. But if you're able to do what we've been talking about, is focus on your customers and demonstrate value, those are the ones that you hope will grow with you over time.
I think the other thing you can do.
Go ahead, Alli.
I was going to say, I think the other thing you can do is start to do an analysis on if you have multiple products, which products are doing really well, right? And I think the other thing you can do is also look at additions. If you have different additions, which additions are really healthy, which additions aren't, right? And you can adjust pricing related to that based on what's renewing well and what's not.
Yeah, Alli, I think that's a great point. That was another thing we introduced, was packages versus products. And I think when you think about how for each of those segments, you create a package that has the right set of value in it for that segment, and right size the package, both pricing and capability, that moves you from selling against each line item. Instead, you're selling like, look, this is what you're trying to achieve as an early stage startup, is X, Y, and Z. This is what we offer you. That's different than a company that's Series C that's going out and they need to expand multiple regions, or they have multiple entities because they're doing M&A. That's a different package. So I think right sizing the package, and this is again where the CS team can really help in terms of looking at, well, what's being adopted across the segment. If the products are not being used, pull that out, throw something else in, and do some innovation in both capability, solution, package, and pricing.
Awesome.
Now is the time to be looking at that.
Yeah.
I think that all that advice makes a lot of sense. We'll take this as our last question, and I'll give this to you, Alli, and also would love to get your feedback, Randy, as a CEO who approves things. How would you sell the need for a CS tool to a CFO or a CEO?
Well, there are multiple ways to sell a CS tool, right? So one of the things that is going to help you build your business case is around segmentation, right? Where are you going to be investing in that higher touch versus where are you going to have to use more of a digital first approach to your to CS in general? And then I think also being able to articulate the importance of that health score. Every CSP is going to be able to show you health scores and be able to give you more predictive analysis. That's really going to drive the conversation around how do I get to those benchmarks, is being able to come to you with more data that we can see, again, the leading indicators and the lagging indicators through data, as opposed to just trying to manifest all of this in spreadsheets.
Yeah, I think it would surprise me that there's a CEO, a veteran CEO in B2B SaaS, assuming that's most of your audience, who would not be invested in customer success. The primary growth engine of B2B SaaS with our business model is current customers. I mean, when you look at Salesforce, one of the things, like the percent of overall growth coming from new bookings versus current customers was, I don't know, like 10-15%. So if your CEO doesn't believe in CS, have him call me. I'd be happy to talk to him about it. But the distinction I would draw is that's very different than what was true in the old legacy on-prem model, where customer success or customer support was a cost center. And so I do think one of the ways you sell a CS tool is, in addition to the metrics, the radar that we're describing, is you think of yourself as a profit center. So if you own expansions and you own, really expansions more than renewals, and you can show that you're driving the business forward, this becomes one of the investments for you to be able to be, well, more efficient and scale, more effective in communicating. And number three is to drive business. Like, the reason salespeople can buy any tool they want is because they're revenue. And they say, hey, I need this tool. I need my next readiness tool. And I need my blah, blah, blah tool. And the CFO is, yes, of course, that's going to drive revenue. So just change the conversation from ticket deflection to revenue driving.
Exactly. And that's why it's so important for all of you to own that number.
Love it. Yeah. Well, I think that brings us to the end of our webinar. Randy, you did mention that SaaS Capital puts out some great benchmarks, and I want to invite everyone to join us in 2 weeks for a webinar that we're doing with them.
Right on. Great.
On benchmarks. They do an annual survey and they just closed that up. So we will be looking at benchmarks of B2B SaaS companies and valuations, and what we're all looking at to compare ourselves against our peers. So please join that webinar. You can find it on our events page on the ChurnZero.com website. And I want to thank both of you for doing this webinar with us. I think it was really great. And I also want to invite our audience to please go ahead and complete a survey that will pop up at the end of this webinar, just to give your feedback. We'd love to hear from you as we continue to plan out the rest of our webinar programming. And thank you everyone for joining us, and have a great rest of your day.
Thanks, everyone. Thanks, Randy.
My pleasure. A lot of fun.
Yeah, thank you.
Go get Churn.